Section 8, Government Loans. Unit 1, the Federal Housing Administration and the Mortgage Market. Unit 2, FHA Loan Programs. Unit 3, FHA Underwriting Guidelines. Unit 4, FHA Loans and the Consumer. Unit 5, Veterans Administration Loan Guarantee Programs. Unit 6, VA Loans and the Consumer. Unit 1, the Federal Housing Administration and the Mortgage Market. Introduction and Objectives. Lesson 1, How the Federal Housing Administration Insures Loans. Lesson 2, FHA Contributions to Real Estate Finance. Lesson 3, FHA Insured Loan Programs. Lesson 4, FHA/HUD Special Programs. FHA Special Loan Programs. Energy Efficient Mortgage. Allows the borrower to incorporate the cost of adding energy-efficient features to new or existing houses in combination with a 203(b) or 203(k) loan, or for 203(h) in connection with a disaster. Home Equity Conversion Mortgage. Insurance of a reverse mortgage for homeowners age 62 and older who want to borrow against their home equity as a lump sum or on a monthly basis, for life or a specified term. Good Neighbor Next Door. This program provides law enforcement officers, K-12 teachers, firefighters, and EMTs a deal on purchasing foreclosed FHA-insured properties in revitalization areas. Eligible buyers receive a 50% discount off list price with a down payment of only $100, provided the buyer lives in the property for 3 years. Homeownership Voucher Assistance. Allows participants to use Housing Choice Voucher funds, which are normally used to pay rent, to help pay monthly homeownership expenses. Applicants must be first-time homeowners, have at least one employed family member, and meet minimum income requirements. Programs for Native Americans. FHA guarantees mortgage loans for Native Americans under its Section 248 program. The loans guaranteed under the program are used to construct, acquire, refinance, or rehabilitate single-family housing located on trust land or land located in an Indian or Native Alaskan area. HUD's Section 184 program is insurance for loans made to Native Americans to purchase, build, or rehabilitate property located on or off tribal lands. Section 184 loans can also be used to refinance. These loans are fundamentally the same as regular Section 203(b) loans, except that they are only available to Native Americans, primarily on Indian land. They also require an agreement with the tribal council in charge of the land where the property is located. Disaster relief. In addition to the 203(h) program, mortgage insurance for homeowners in presidentially designated disaster areas who require major repair or replacement of a damaged home, the FHA has placed a 90-day moratorium on foreclosures for homeowners with an FHA loan who are trying to repair or rebuild after a natural disaster. Loan servicers are required to work with the homeowner on payments, including waiving late charges. Lenders are also required to release homeowner insurance proceeds to the borrower. FHA Reverse Mortgage Program. Reverse mortgages are nothing new, they've been around for decades. Thanks to FHA's mortgage insurance, HUD's Home Equity Conversion Mortgage, HCM, makes borrowing equity from one's home less expensive and safer for both the lender and the homeowner. HECMs are now the most common form of reverse mortgage. Example. Gerald is a 72-year-old widower, and although he's paid off his home, his medical bills are starting to overcome his fixed income budget. He decides to make use of the equity in his home, so he obtains a reverse mortgage through a lender that participates in HUD's Home Equity Conversion Mortgage Program. The HECM program allows Gerald to decide if he wants to receive the money from the lender in a lump sum, on a monthly basis, or as a line of credit. Gerald opts for the monthly payment, and chooses to receive this for as long as he continues to live in his home. He could also have chosen monthly payments for a fixed term, and if Gerald's circumstances change, he is allowed to restructure his payment options. Gerald now feels much less financial stress. Based on his age, the fact that his home was fully paid off, and the value of the home, he was able to borrow a substantial amount of money. Gerald can now cover all his bills with the monthly income from his reverse mortgage. He's careful to continue paying his homeowner's insurance and property taxes, since he was counseled that not doing so could result in foreclosure. He also knows that even if he outlives the amount that he borrowed, his monthly payments will continue as long as he continues living in the home. As it turns out, Gerald lived to the ripe old age of 85 and was able to remain in his home until the very end. At that point, it was time to repay the loan, which his heirs did in the most typical way by selling the house. The sale price covered the repayment of the reverse mortgage, with enough left over to give each of his children a small inheritance. Gerald qualified for the HECM program by virtue of being age 62 or older and having paid off his mortgage, or having a very small amount left to pay. The amount that a homeowner receives from a reverse mortgage is based on property value, the borrower's age, and current interest rates, with a total loan limit that is set annually by the FHA. Program benefits. The benefits to those who want to obtain the HECM include: no monthly payments, no asset or income qualification or limits, the option of receiving a percentage of the value of the home equity in a lump sum on a monthly basis, or as a revolving line of credit. No repayment of principal, interest, or fees until the surviving homeowner leaves. Continued payments as long as a surviving spouse remains in the home. No debt to the estate if the eventual sale does not repay the balance owed to the lender. The FHA will cover the remaining amount owed to the lender. In addition, the Housing and Economic Recovery Act of 2008, HERA, added new provisions to protect seniors who use the HECM program. These include the ability to obtain an HECM loan in a single transaction, for seniors for whom the home is a primary residence. Counseling, to help homeowners understand that the equity payments could result in zero equity. A prohibition to lenders from requiring the borrower to buy insurance to protect the lender from a negative balance at the end of the loan program. Homeowners are still required to carry hazard and other homeowner insurance, and must make these payments or risk defaulting on the loan. A limit of origination fees to 2% of the maximum claim amount up to $200,000, and 1% of the maximum claim amount over $200,000. Lower valued homes, less than $125,000, are limited to a $2,500 fee. Note, since HERA, cooperatives are now included in the program, as well. As with other FHA-insured loans, the FHA collects an insurance premium from all HECM loans. The premium is 1.25% of the loan value. An initial mortgage insurance premium fee, if applicable, will be between 0.5% and 2.5%. FHA loan programs. The names of these loan programs derive from the legislation that created the FHA. Titles 1 and 2 of the National Housing Act of 1934 delineate the types of loan programs offered by the FHA. Title II programs are named according to the section within the title. Title I, Property Improvements. This is loan insurance for moderate rehabilitation of properties. Loans on single-family homes may be used for alterations, repairs, and site improvements, includes construction of non-residential buildings, such as garages. Loans on multifamily properties may only be used for alterations or repairs. Loan amounts and terms vary by type of property. Title I, Purchase of Manufactured Housing. This is loan insurance for the purchase of manufactured homes. The loan may be used to purchase a manufactured house on a developed lot, to develop a lot for a manufactured home, or a combination of the two. Loan limits vary by year, and may vary by location for high-value areas. Example limits are $69,678 for the home, $23,226 for the lot, and $92,904 for both. Current limits may be found on HUD's website. Note, if the loan required is higher than these limits, some Title II funds may be available. Title II. Title II covers loan insurance for many properties and situations. Each program has its own rules. Some of the options available from FHA are: Section 203, the purchase of 1 to 4 family homes. Section 203H, victims of disasters may receive 100% financing to reconstruct or replace a damaged home if they file within 1 year of the disaster. Section 203N, purchase of a unit in a cooperative housing project. Section 221D(3) and for construction of multifamily rental or cooperative projects. Section 223E, purchase or rehabilitation of a home in an older, declining urban area. Section 234C, purchase of a single condo unit. Section 251, Loan Insurance for Adjustable Rate Mortgages. Section 255, Loan Insurance for Reverse Mortgages for borrowers age 62 or older. How the FHA helps the mortgage market. The Federal Housing Administration's, FHA, participation in financing home purchases has served to stabilize and improve the mortgage market in the years since it was established. Here are the main strategies that the FHA uses to increase stabilization in the mortgage market. The FHA set basic standards by which to qualify borrowers, helping to reduce lender risk. These standards have been adopted by all FHA-approved lenders. The FHA also requires specific construction standards for properties purchased with FHA-insured loans, making buildings safer and longer lasting, which reduces lending and insurance risk. The FHA introduced the long-term amortized loan. Loans provided prior to the establishment of the FHA required as much as 50% down and had to be paid in full within 5 years. As you can imagine, homeownership rates were dismal back then, with less than 20% owning homes. The long-term amortized loan is in many ways responsible for today's homeownership rate of 65%. The FHA has also influenced the appraisal industry. Since September 1999, the FHA has required that all appraisers evaluating property for FHA-insured loans be state licensed or certified. The stability the FHA brought to the mortgage industry opened up the global market for mortgage-backed securities. The Federal Housing Administration Loan Insurance. So what are the nuts and bolts that you really need to know about Federal Housing Administration, FHA, loans? Here they are. The FHA loan insurance program helps buyers who may have trouble qualifying for a conventional loan. This includes many first-time homebuyers, as well as borrowers with credit issues or inadequate cash for a conventional down payment. Buyers don't work with the FHA directly to participate in the loan insurance program. Instead, when a mortgage loan officer, MLO, evaluates a buyer's loan application, if the applicant isn't able to qualify for a conventional loan, the MLO will see if the applicant can qualify using FHA standards, which are less stringent. If the consumer qualifies for an FHA loan, the borrower gets the funds to buy the property, the lender has a new customer, and the loan the lender makes is insured by the FHA, so the lender assumes less risk. The FHA pays lenders claims with funds collected from the mortgage insurance premium, MIP, that each FHA loan borrower pays monthly. In most cases, MIP must be paid for the life of the loan. The FHA is a federal agency established by the National Housing Act of 1934. Since 1965, the FHA has been a part of the U.S. Department of Housing and Urban Development, HUD. FHA's mission is to increase employment opportunities in the construction industry and to stabilize the mortgage market by establishing standards for lending and construction, and by insuring mortgages. Only FHA-approved lenders may participate in its loan insurance program. Approved lenders are most commonly part of the FHA's direct endorsement program. Direct endorsement allows the lender to perform the property appraisal, evaluate the borrower's qualifications, and approve loans according to the FHA's guidelines, which streamlines the process. Otherwise, the FHA would have to qualify each borrower, adding time and steps to the application process.